The Quantum Group USA, LLC in California, DBA Quantum Distribution and Insurance Services. Advisors are responsible for following all insurance, DOL, FINRA, SEC, broker-dealer, and compliance officer approval requirements prior to distributing this information to clients. Welcome back to More Market Insights, our monthly conversations with Andy Moore, Quantum's Vice President of Advanced Planning and Portfolio Solutions. Markets are sending mixed signals. The Fed's words matter more now than ever, and income strategies are evolving fast, from seasonal market trends and headline-driven volatility to interest rates, income riders, and a bold new outlook for the S&P. There's a lot for investors and advisors to unpack, so let's break down what's noise, what matters, and how it all fits into a smarter financial strategy. And let's start with the markets and the Stock Trader's Almanac. You know, the Santa Claus rally, the first 5 days, the January overall. How reliable are those compared to the fundamentals typically?
I would say from a historical point of view, going back to pre-1950, it's pretty accurate. When you have a trifecta of the Santa Claus rally, the first 5 days in January, and then January as a whole as a barometer. When all three of those are positive, more than 85% of the time, the market has a positive year. It looks like this year we'll hit 2 or 3. So for the third straight year, the Santa Claus rally didn't happen. Santa Claus didn't come to Wall Street, so to say. It was fractional this year. I think the S&P was down 3 basis points. So basically flat, not a big mess. First 5 days was really good. Today, Tuesday, the 27th, I think it is, filming a little early due to some travel schedule. But new closing record high today on the S&P. So it looks like January is going to be a positive year. So 2 or 3 gives us a good percentage of 75, 80% that the market should be positive this year. But as you and I alluded to, there's a lot of bulls now after 3 double-digit returns, almost 20% last 3 years. I wouldn't be surprised if there's a good hiccup or correction mid-year sometime.
When these things kind of line up, what does that tell us about investor sentiment in general?
I wouldn't say it's so much investor sentiment, because if you remember, we do this every month. If you remember back to 2025, investor sentiment for the whole year was pretty much negative until the end of the year. So investor sentiment, as you and I have discussed, I look at it as a contrarian indicator. So right now, as we get more bulls and bears, it makes me a little bit nervous in the short term. Last year, of the 12 months, I would say probably 10 and a half of the months we had negative investor sentiment.
And now let's talk about Trump. Greenland, Iran, now Canada's in play.
Everyone's in play.
Everybody's in play. How does that impact short-term volatility versus the long-term fundamentals? Because right now we're just in an echo chamber of stuff.
Yeah, it's definitely short-term noise when he gets to Twitter or Truth Social, wherever he's thrown his rants. We'll call it his rhetoric. But in the long run, it's really the fundamentals. Wall Street doesn't like surprises, so when he does throw a curveball or a tweet out there, you'll get the short-term reaction. Just look at Liberation Day, back in April. It was a little bit more excessive than a lot of people thought. Really bad correction. Some would say we were in a real quick bear market after a couple of weeks, but then it was the most hated V-shaped rally that I've ever seen going back to the early 90s. And that goes to your investor sentiment, comment. Everyone was negative, and tariffs are going to be runaway inflation. Inflation's in check to a degree, definitely trending lower. Housing, if we can get that under control. I think unemployments are a big, kind of what if right now that the Fed's going to be keeping an eye on. But, to answer your question, it's a short-term noise. Doesn't affect long-term fundamentals and valuations of companies, though.
And the Fed meeting today and tomorrow, there's a small chance of a cut, like 5%, which means probably not. What should investors be listening for in this conversation to kind of get an idea of what's going to happen?
Yeah, and I think the markets react a lot more to what they say after the meeting. It is, to your point, expected not to cut rates. I did see someone today that kind of threw a Hail Mary out there that they're going to cut 25 basis points. But the percentages right now is less than 5%. the actual number of rate cuts for 2026 from a Fed funds future perspective have actually come down from about 3 cuts this year. It's priced in right now at about 1.7, so less than 2. I don't think with Trump going to nominate a new Fed chairman, which should take over in May, I don't think you see much until June. So I'm in the camp that, status quo right now. Keep an eye on the language, as you said, as it pertains to unemployment and wages. Wage growth is slowing or coming down. Unemployment's ticking higher. That would give me a little bit of worry that the Fed still might be behind the 8 ball where we're at from a monetary policy. Our short-term interest rates are still higher than a lot of the other developed countries out there. We could probably be 50, 100 basis points lower, but right now we're not.
And so you've said, as you just mentioned, too, the labor market is probably the Fed's biggest concern right now. What data points, you're talking about wage growth, you're talking about unemployment, what other data points do people need to look at?
Those will be the 2 main ones. When there's a lot of other variables that go into the labor report, but the 2 headline numbers is 4.6, 4.7% unemployment, it's ticking higher. And then obviously wage growth, because if we have a lack of wage growth in the marketplace, our consumer debt is over $1 trillion and rising. Trump wants to put a cap on credit card rates at 10% to help people pay that off. But if we don't have wage growth and mounting personal debt, we already know our fiscal deficit and our debt is approaching 40 trillion. That's kind of gotcha for the Fed, I think.
So let's look at the 10-year Treasury, which is at 4% right now. How does that affect income riders and other retirement income strategies right now?
So the last 2 years we've been talking about, refinance your retirement, refinance your annuity. And a lot of that evolved around big upfront cash bonuses, which let's get to the white paper 8500 that we just updated. But the income riders have gotten super competitive as of late. I'd say the last 18 months. But we're actually seeing as we go into 2026 some more bells and whistles coming out. We have a new carrier launch February 9th from a group out of Connecticut. So brand new insurance company. One of the founding partners actually turned around F&G back in the day, took them from a B++ to an A-rated carrier, and then sold them off. So a lot of experience in the marketplace, but they're going to be very competitive on the income play. What I want to highlight kind of today, talking about income riders, is the long-term care features and benefits. So looking back, just 5 years ago, a lot of those LTC benefits were confinement. And then you'd get a doubler up to 5 years. What a lot of those old income riders, the feature was you got double the income, but only if there was account value left. So as soon as account value went to 0, the doubler would stop. So on these old policies, low cap rates on the S&P, low par rates on the vol control indices, most likely when an individual is going to need long-term care, they're in their 80s. I think the actuarial date's about 82, 83 years old. If you buy an income rider at 65 and you want to defer income for 5 or 10 years, you trigger at 75 with maybe an income fee, no participation in the S&P, that account value goes to 0 pretty quick. So when that client actually needs a long-term care benefit of a doubler, they're probably not going to have it. Two products that have just upgraded their income riders and the new one that's coming out, they actually have that doubler guaranteed for the 5 years, even if AV goes to 0. The newer product that's coming out, and call your VP, it'll launch on February 9th, the account value can go to 0 before you trigger income, and they'll still allow you to trigger income and get the doubler for 5 years. Plus it's a 200% for single end joint. A lot of the joint doublers out there, they reduce that to 150. So whether it's one spouse or the other on joint, you get that 200% roll up for 5 years, and you can stop and start it. So if I need LTC, at age 80, account value is 0, I can still double that income and say I live 2 more years, then my wife's doing well, and then 3 years later, 4 years later, she's in her late 80s, needs that LTC benefit, she can then double her LTC benefit for 3 years. So it's a pretty unique design. I would recommend any advisor out there that has income riders on the books, especially if they're old, let's see if we can get you more income. But if you're looking for that LTC benefit, there's a stat that I saw, 77% of retirees need income or need LTC after the age of 80. I can't remember, it might have been AARP or whoever did the study, but that's a pretty significant story, especially if you got an income rider in your low to mid 60s and you're hoping that doubler kicks in. And if it's in the 80s, you probably won't get it.
And then let's go back to the S&P, which now you've updated your white paper. Now it's 8,500 is what we're seeing. So that's very exciting.
Yeah. What
should investors be looking at, again, before getting too excited about all of this? Because that's great news. But what should they be watching?
So the whole premise of this, and we've updated it now since fourth quarter of last year. This is the third one. So on S&P 7,000, 8,000, now 8,500. And the whole premise is, let's take asset classes today and sell them at 20% higher valuations. We say S&P because that's the benchmark. It could be value stocks, it could be CDs that are coming due, whatever that may be. But again, just shy of 7,000 today on a closing basis. I think our intraday high was 69.86 or something along those lines. So 7,000 with a 20% bonus, 8,400. Plus, you're going to get a 6 to 8% cap on a raw index, S&P, NASDAQ, Russell, EFI. So now you're talking 26 to 28%. That puts you close to 9,000 for the end of 2026 if the market continues to go higher. It just makes sense for me as a retiree to take those. I still manage money. I've been a net seller here the last couple of weeks. I actually think there's a 20 to 30% pullback sometime this year. Doesn't mean we can't close the year 6, 7, 8% higher at around that 75, 7,700 level. But the one product that we specifically use in this S&P 8,500 white paper is a security benefit top ridge. And the reason we use it is the 10% free partial withdrawal original premium, and accumulates for 3 years up to 30%. So if you're hearing this for the first time, it's our most requested white paper in 2025, and I'm sure it will be in 2026. If I take assets, say I put $1 million in it, it's now 1.2 million. I get 6% cap, so now I'm up to, add another 70,000 to that, 1.27. And the market pulls back 20%. I can take $100,000 and roll it back into my value stocks, or I can take $100,000 and maybe Bitcoin crashes 50%. And you want to be aggressive in that area for an advisor that has clients that want to dabble in Bitcoin, for example. I'm just throwing ideas out there. Mm-hmm. For a retiree, I wouldn't recommend probably Bitcoin, but just for a scenario, it just makes a ton of sense with 3 years of 20% gains. We'll call it. S&P was 18% last year. We already talked about wage growth is going down. The end user clients aren't saving as much. I just saw a report that says savings are way down. Credit card debt is through the roof. And then the other thing we talked about it probably mid-year last year, might have been around May, June after we had Liberation Day. We referenced that margin debt was extremely low. I think we were about $800 billion. That's now about $1.3 trillion. So margin debt, as it comes to portfolios, hedge funds, is the highest it's ever been. So I see a catalyst for that, decent correction, small bear market this year before a year-end rally.
So for most clients, I think what you're saying is there's probably no reason not to do this at this time?
There's no reason not to. If you're in your 40s, early 50s, you can manage the risk in the portfolio. But for a retiree, seekers of returns, markets have treated us really, really well the last years, really since 2008-9, the financial crisis. We've had a couple hiccups, 2022 dual bear market. Yeah. But for the most part, I wouldn't say the easy money's been made. Does the S&P go to 10, 12,000 over the next decade or 20 years? Yes, that's how you build generational wealth and the society we live in. That's how our monetary policy and economics work, so to say. But for right now, there's I think more risk in the market than there needs to be for a retiree.
Well, that's Andy Moore, Vice President of Advanced Planning and Portfolio Solutions here at Quantum. This is our monthly conversation about markets and a bunch of stuff, as you can probably tell. And again, Andy, you're always available for advisors, aren't you?
Always available. So day, night, rain, shine. Just let us know what you need.
If you need something, don't hesitate to call. But thank you for listening. Thank you for watching, and we'll see you next time.